weekly Fast Track Money YouTube live session. As usual, I'm with Matthias Richter. If this is your first time coming here, I'm Yasi. I'm creator behind Fast Track podcast. And then we also have a website, fasttrack.live, where you can find all the informations and learnings from touching on the topic of entrepreneurship, money, and career. And my co-host is Matthias Richter. He is the creator behind Financial Imagineer. Financial Imagineer is a blog platform where he shares his personal experiences and knowledge on financial, let's say, personal finance, because he achieved financial independence at the age of 37 as a banker, and he knows a lot about money and investment. Therefore, we come together having this weekly Fast Track Money live session to talk about investment, savings, money mindset. And if you have any questions, feel free to leave in the comments. Some of you join us from Facebook, YouTube, or Twitter. And we are here to help you imagine your life financially. So, Matthias, what we are going to talk about today?
Today is a special topic. It's very close to my heart in a way. So it's about creating income streams, or just generally creating income from your portfolio. Because usually if you are investing, the problem is you sit on some assets and you may be very asset rich but cash poor. So I know some people, they say, I am asset rich but cash poor. That means you have a lot, but you cannot make use of it. You cannot buy stuff. You cannot cover your expenses if you own a lot, but don't make it work for you in a way that you have cash flow. So today we're going to dive into some kind of webinar form to showcase a little bit how to generate cash flow from your investments. We have different ways, and maybe I start to share the screen.
Yeah. And if any of you here have any questions, feel free to write in the comments, and every now and then we can jump into the Q&A section.
Yeah. So one thing about that is why I think this is an important topic. If you look at this chart, it's a very, very long-term chart. It's 150 years, and you have different countries here. And what do they show? It's showing the long-term government bond yields. So you see actually in Switzerland, for instance, it's a negative yield at the moment up to 10 years. Other European countries are also in the negative zone. Japan is in negative. And you see in a way that in this kind of environment, if you just want to live off your assets and generate money the old-fashioned way using bonds or fixed income kind of products, it's close to impossible because interest rates have been trending to zero. Now, why is that? One simple explanation is supply and demand on one side. So you have a lot of retirees that quit their job, and then there's a lot of supply of cash, and people readjust their portfolios to more fixed income things. And so much money there that at the end, there's too much supply and not enough demand. On the other side, the Fed and other central banks, they print even more on top of that. So it's quite a special situation to be in. So money is abundant. There's too much of it, too much liquidity around, and you cannot just make it work for you by sitting on it in cash. So that's the problem. The other problem, of course, this is why this is important, is inflation is surging higher. So thanks to COVID and the recent situation with some shortages, inflation in the US hit around 5% at the moment. So if you don't make your cash work, you just sit on your cash and don't invest it into assets, you actually lose 5% purchasing power per year. Of course, we do not expect this inflation level to remain as high as it is now, but this is like the problem at the moment. So on one side, money losing its value, on the other side, not generating enough for retirees to live off. And that creates an opportunity, of course. So what to do? I think very important is you might want to understand in terms of bankable assets. So today we talk about bankable assets. There could be other things like real estate, businesses, and so forth. Today I just want to cover bankables. How can you create income from your holdings? So maybe here I have a little overview from fixed income interest. Yes, it's still possible to get something there. Dividends, more traditional thing. We also have income from specific income funds or asset allocation funds, which could be something for you. Security lending, something very interesting, maybe a little less known amongst many of you. It's also a way how you can monetize your assets. Then selling of calls and put options, which could be extremely interesting in times of elevated volatility in the market. And ultimately, structuring tailor-made solutions, which goes a little bit further into financial engineering, which I also like a lot. So there I can even showcase you some examples. And the ultimately last one, I put it with exclamation mark there, is capital gains, because it's not income generation per se. It's more like you sit on it, wait until it goes higher, then you sell it. So you cannot just derive income from capital gains, but it's a way, if you plan for that to actually help you to make money, it could be interesting as well. Yes, so sorry, I kind of just bring this list. Any questions, Yasi?
I think maybe one question on behalf of the audience, that you showed the slides before, the interest rate is getting higher in the US due to inflation, etc. What would be the implication for investors? Because naturally, I think the return would also be higher, right?
So if interest rates are very low, money is cheap, people borrow more, the leverage and gearing factor in the economy is higher. You see a lot of people have more mortgages. In the US especially, you see that housing prices are so crazy high that actually you have to pay above the ask price to get a settlement. So it's a little bit overheated. It has a little bubbly feeling into it. But on the other side, you see how inflation picks up. So at the moment, there's really no other place really to put your money in. And for the longer run, if actually earnings manage to pick up, we are just at the start of the Q2 earnings season this week. We're in July 2021, if you watch that later, recorded. So we actually believe this will be a record earnings season, and eventually there could even be some surprises to the upside. There have been some analysts who revised forward guiding earnings even higher for the next year. So it's in a way a very special situation. Usually in such situations, the long-term estimated outlook for earnings is not that great because everything is at all-time highs. But I remain very optimistic on it because I see the recovery is gaining momentum, and also money is cheap and it will remain cheap for at least another 1 to 2 years for sure.
So on the other side of the coin, for people who have not invested, have no position, have no borrowing, so they are suffering from the inflation then.
Yes, exactly. So if borrowing is one thing, right? If you have the holding power to hold a mortgage or have a loan on your assets, in a way you are aligned. Your interests are aligned with the interest of the central bank. So if they print more money, if the governments have higher debt levels, you are on their side. And if they have to inflate their way out of it, then you will win because you also have more debt. The problem, though, is if the whole thing will end in a crash, and eventually your assets that are the collateral for holding your loans will suffer, or you have no longer the ability to hold the loans. You may have a margin call, you may go bankrupt, and that could be terrible in a way, right? So these are the ups and downs there. So fixed income, in a way, that's the old traditional kind of way to look at building a portfolio for retirement. People kind of like the predictability of it. You have a bond that gives you like 4 or 5% per year, and that's it. But this, at the moment especially, is quite dangerous in a way, in case interest rates were to go up. And we don't know if inflation is at 5% in the 1970s, 80s. I'm not expecting that, just disclaimer here. But in the 1970s, 80s, inflation has been jumping very, very high. And somehow, sooner or later, the Fed went up with interest rates. And if that happens and you buy a bond today, you buy a fixed income instrument today, let's take an example. Let's say you buy a 10-year fixed income bond that pays you 3% today, every year. Now, let's say tomorrow, the 10-year interest rate will jump up by 1% to 4%. Let's just assume that as an example. then what will happen to your bond? If you pay $100 today, this thing will drop by 10% tomorrow. Of course, if you wait the whole 10 years, you will still get back your 100. The capital will get back there as long as the issuer doesn't default. But in the short term, you will experience fluctuation that you do not want if we are talking about these things. Because if tomorrow you want to sell your 3% yielding bond to someone else at the open market, that person want to have 4% because that's what the market will offer. And the 1% that is missing between 3 and 4 will come from the price. So your bond will drop by 10%, which can be very, very painful. So therefore, be extremely vigilant with fixed income. There are some solutions. If people still want to do fixed income, there are some special fixed income funds that do more like floating rate fixed income kind of investings. That's more the short term that will adjust every 3 months. There are some funds out there that invest in mortgage-backed securities. So you that was the thing that caused the financial crisis in 2007 and 8. There are things like that out there that can help you to still generate income today up as high as like 4%. You can look in high yield space, but I would rather look at shorter durations, shorter time till expiry. So you can actually reset your coupons going forward, because that's the big risk. Interest rates are super low, and who knows how long they're going to stay there.
We have a question from the audience.
Yep. Yes. Okay. Would be good if you could mention the ideal time for each instrument. Okay. Thank you for that question. Very, very valid. So I think it also depends. Simple answer. For fixed income, if you kind of look at that because of the uncertainty inflation, I will keep it very, very short, or keep the duration short and have a floating rate note. I will be mentioning the ideal investment horizon now going forward. Thank you for that question. Maybe the next thing we cover are dividends. Dividends is you buy shares of companies that produce positive cash flow in excess of what they need to kind of give back to finance the business, the growth, and so on. And that's a way to kind of monetize your assets. There could be some arguments against it, which is if you get dividends, you have to pay income tax. I mean, this kind of thing depends on where you are. There are countries like Singapore and Hong Kong where there's no income tax on dividend income. There are other countries where income tax is similar, like capital gains. There's countries without capital gain tax, but income tax. So it depends where you are for this. But dividends are a way to kind of profit from a growing business that has a very good cash flow that allows them to share some of the profits with you as the investor. And of course, I take a very simple example. For instance, Nestle or Coca-Cola, they are producing food. So as long people are hungry or thirsty, they're going to buy products of these companies. And now if we have 5% inflation and maybe your can of Coke was $1, maybe next year it will be $1.05. Maybe 2 years later, it will be $1.10, something like that. But these companies do have one advantage. The big companies, they have a brand, they have a value behind that, which means they have the pricing power. And I think in this environment, it is extremely important to look at companies that do have pricing power. Why? Because if inflation comes, it will hit them on the resources side. They will have to pay higher prices to get their ingredients to make their products. They have to pay higher wages and so forth. But if they have the pricing power, they can simply go higher with the price for the end client, which is you if you buy the Coke. And therefore, their margin will stay the same. So if the company earns 30% on $1 and 30% on $1.05, this is actually what you want as investor, to have a company that is able to retain the margins, the profit margins. So if you're investing in a weak company, the weak company might lose out on that. So the margin might be squeezed because eventually the end client is not willing to pay more. Dividend investments, I think the ideal investment horizon for this is as long as you think the company is really still good. There could be dividend companies that pay very high dividends that are not healthy. Beware of that. There could be, because they are draining themselves. So companies that do have a very high dividend, could also be a sign that, number one, they don't know what else to do with their money. So they don't know how to reinvest in their business. So they rather give it to the shareholders. And it could be a sign that the company is running low on cash. And if they have issues, they don't have enough reserves and stuff like that. So it could be an unhealthy sign. But there are companies, I like some companies that have farmland, for instance, in the US. They kind of just pay it on, right? So if inflation happens, they rent farmlands to the farmers. They simply keep adjusting their dividends higher. That could be a beautiful thing. So think inflation hedge there. Think income stream. If you are not eager to sell, this would be the last part of this video, the capital gain part, right? Other companies, instead of paying dividends, like Warren Buffett, he does not like dividends at all. He will rather buy back his own shares, which is another form of giving back cash to the end client, which is the investor in a way. So instead of you getting the money by a dividend payment, he simply buys back some of his own shares from the market and destroys them. The whole market value of the company will remain the same, but it's divided by lesser units. So each unit becomes more valuable by an amount that is maybe something like the dividend. That could be another way. But dividends, if you're looking for income, they could clearly be something to look into, because if you invest with the right company, you're inflation hedged. You will get a steady income stream, and you don't have to worry about how to conquer the low interest rate environment, so to say. Now, there is some income funds. I will later also show you something about that. I have a fund that I like quite a lot myself. It is a multi-asset fund. It's investing partially in US convertible bonds, 1/3. It's investing in US equities with a covered call overlay strategy on it. I will actually explain that in more detail later. And it's also investing in US high yield bonds. The beauty of this kind of construct is the 1/3, 1/3, 1/3 approach is like a barbell strategy. So whenever one of these parts is increasing in value, the fund manager will reduce the exposure and allocate to the ones that are not doing well. This kind of strategy in US dollars yielded around 12% per year for the last more than 10 years. It was quite good. The covered call strategy means the equity portion you hold, the fund manager is selling call options on the holdings and reduces somehow the upside by a certain part, but still generates additional income. The high yield part is if you have shorter rated high yield bonds. High yield is also, it used to be called junk bonds, the kind of lowest grade of interest generating vehicles. They're actually, it's quite interesting, right? They could go bankrupt. And if you just have money to buy 1 or 2 bonds, you shouldn't buy the bonds. You should diversify. If you have like 20 to 30 bonds, it's better. So go with a fund if you look at bonds. And if one of them defaults, the fund manager usually is better than you yourself to reclaim some of the lost assets with legal sue cases and so on. That's one part why I like it in a fund. And the third part is convertibles. These are bonds that could be converted into equities. So let's say you have a bond that eventually could become an equity. If the market crashes, it's kind of converted, but then at a lower level. So you will get converted and become shareholder of some of the companies of which you bought the bonds of before. And while you wait for that to may or may not happen, you get compensated with yield. You get a higher yield than for a normal bond because you have a higher risk as well. Such funds, there is one fund out there that pays like 7.2% annual dividends every month. So every month you get income from that. I like it a lot. I will quickly show it to you later in this video and show you how this is calculated.
Do you want to also highlight that whatever you show is not an investment suggestion?
Of course, yeah. So this is, I show you certain tools, certain strategies. Whether they make sense or not, please do your homework. If you are not sure, talk with a financial advisor, somebody that understands it. We just want to walk you through different options, how you can kind of create income from your portfolio today. Thank you. That's a good hint. One other thing, it's called security lending. this is something very, very hidden. Most people are not aware of this. So what does it do? Security lending is nothing else than, let's say you are a hedge fund and the hedge fund wants to short shares. But now the problem is some exchanges do not allow pure short selling. So you cannot short shares that you do not own. And now the point here is you have to borrow them from someone. But who will offer their shares for borrowing? I wouldn't know how to do it myself, right? So you would have to go to a lender. You have to have supply for that. And the interesting point here is I used to work in a bank, in a big bank that has a lot of clients who have a lot of shares there. And if you're a client of such a bank, you can sign a document that is called Security Lending Agreement, which allows the bank to use your securities and give it to a borrower. So let's say you have a share. I don't want to call any names, but imagine a very highly volatile share. We have seen some shares earlier this year with some memes and stuff that goes up and down and swings. The higher these swings are, the more attractive these shares become for hedge funds to kind of short. And also the higher the swings are, the higher the price will be to borrow them. And therefore, if you own these shares and for whatever reason you want to hold on to them and borrow them out, you get compensated. You will get a reward, lending fees. I have seen lending fees as high as 20% per year on crazy shares. And this is something that is happening. The problem here is, I also want to mention the risk. The problem would be, let's say you have a lot of shares, you borrow them to someone. If the hedge fund goes bust, it doesn't matter. The shares are still with you. But the problem is if the lender, if the company that does the agent lender does the agreement goes bust, your shares are actually with that entity and you have an issuer risk there. You could lose everything in such a thing. So it's highly risky eventually. If you plan to do that, choose to do it with an entity that is very well backed, has sufficient capital on the side. It sounds very complicated. Sorry for that. But this could be an interesting yield enhancer to unlock this kind of things. There was also a lot of talk when zero cost ETFs came to the market. There were talks about why somebody is offering ETFs at zero instead of like Vanguard 4 to 6 basis points or something else. Eventually, companies that offer things for free, they may have other ways to monetize. Whether or not this kind of security lending is used, this could be an option for companies like that to monetize the holdings, right? Other companies, they monetize the flow. We have seen that maybe with other traders that do internet trading. So if you have bigger packages of buy and sell, you become the market maker and you give it to bigger funds and you monetize the difference, which could be quite tricky because you are not sure you get the right price as end user and you will be monetized on. So I always advise if something is for free, beware. It means you are the product. You are part of the product. So be very careful of that. Sorry, this one more complicated. But if you have a lot of shares, a lot of holdings in a bank, ask your bank if they offer security lending, if you trust the bank to not go bankrupt. This could be an interesting yield enhancer. This one here will be call options and put options. One thing is very interesting in the market. Usually the people who buy options, they earn overall less money than the people who sell options. Now that's very interesting because buying options, you have to pay an option premium and you usually have unlimited upside or downside. Limited downside, you have unlimited upside. But if you sell the option, you kind of just receive a one-off, you receive a premium and you have unlimited downside in a way. But it could be capped. I tell you how. So for instance, covered calls. What is a covered call? A covered call is for instance, you have shares. Let's assume you hold a lot of shares of one company and you wouldn't mind to sell it if it goes 10% higher than currently the market price is. So what you can do is, let's say your share trades at $100 per share. You can sell a call option at $110. Maybe this call option will give you $1 or $2. So it could be extra income. It could be an extra 1 to 2%. As long as you keep holding the share, you're entitled to the dividend. And in the best case, at the end of the option expiry, your price will be below 110. If it climbs to 200, sorry, you have to let go of your share at 110. So you cap your upside, you lose out, but you don't lose more, right? You would lose more if, let's say, you get this option price and you don't have the share. So if you don't hold the share, you write the call, the share price goes higher, you will have an unlimited downside in a way, which could be super dangerous. If you short a put, this could then be the opposite. So let's say your share is at 100, you sell the call at 110, the share price goes to 112. Now what you do, you have money in your bank account, you can actually short the put option. Maybe you short a put option at 100 again. That may give you another $2. And if the share price goes below 100, you get back your share. And you can do this kind of strategy on both sides. Here, that's the opposite if you buy the option. Of course, if you buy a long call, you participate on the upside of the share price unlimited. But if by the expiry date nothing happens, or it just moves up a little bit, not to cover your outlay, your option price, you don't break even, you lose, right? The same thing if you long a put, if you want to buy insurance in the market, if the share price drops, you earn. But anyway, this is just extra. But covered calls, I like quite a lot. And if you short puts, I usually only advise it if you really want to buy the share, number one. And if you have sufficient capital aside to pay in case you get delivered. This is quite complex. Reach out if you have any questions on that. Happy to explain.
Maybe you can also tell the audience in financial terms, right? What does long and short mean, or what does call and put mean? Because these are like financial terminologies. Yeah.
Okay, long means you buy something, you have something. Short means you sell something. Call option means you have the right to call upon something that is agreed on. For instance, to buy a share at a certain price at a certain time. And put this, you have the right to put something to someone else, to let something go. And then you combine these two and you have these four combinations. So this is looks quite complicated, and yes, it can get more complicated. So I don't want to get too complicated, but this could be the last part I want to cover for that session. These kind of options can be used to do tailor-made income solutions. So they're called structured products, and depending on your view, there is almost anything you can structure. If you express a view on certain things, as long as it's traded at one exchange in this world, there are companies out there that can help you kind of set it up. And you see here, this example looks very complicated, but in that case, such a product may have a barrier. So you may have a downside protection. If the stock price drops here, you don't get any loss until it drops too much. Then you get back to normal loss. And if it goes up, you may have gradual income that could get provided here. These things I could walk you through maybe in another session in more detail. But the beauty of it is you can do products on anything in the world. You can do it on one share. You can do it on two shares. You can do it on currencies, on gold, on bonds, you can do it on countries. If you have a view on a country, it's amazing what you can do. And you can also hedge it back into your currency. Of course, if you have US dollars, you do it in US dollars. But if you have euros or Swiss francs or yen or Singapore dollars, you can hedge it in whatever currency you want to do it. And you can generate more tailor-made income from that, depending on your view. Of course, one thing to be said here is there is always a risk involved. So be aware what kind of risk you enter here. In this case, you may still have unlimited downside, and maybe you lose out on the upside. That could also be a risk. Let's say you choose a good share, it goes up too much. If you have no if your thing stops here, then that's it. You will not get more money than that. Lastly, this is maybe the simplest of them all, capital gains, right? So if you invest You buy Berkshire Hathaway shares, you buy the SP 500 ETF. As long as the economy grows, the company grows, your money will compound, right? And then how to generate income from that? The simplest way is to once in a while to sell something, right? Now, this looks a little bit like, oh, why should I sell when it goes up? You may need it, right? And if you get older, you maybe have a portfolio with more aggressive and more conservative positions. And if positions grow on one side, you can kind of slowly sell it and rebalance every once in a while. So that means if, let's say, you have a very good year in the stock market, prices surge up by 50%, then you just cut a little bit on the top and rebalance to the more secure position, and you take out a portion for yourself. If the markets were to drop 50%, then you sell the more stable portions. They may also go down, but go down less than the aggressive portions. Then you do not cut the aggressive part. And by doing that, the capital gains, or like playing this market variation, you can also get some cash out and generate income in a way. But this, I admit, this is not pure income generation. The other strategies I've shared before are more the income generations. So thank you for your attention on this. This was my short presentation. I will close the screen sharing here. I have some other things I could share, but maybe Yasu, you have any questions on this? I hope it was not too complex.
I think one of the more complex slides is the call, pull, and long short, because first these four concepts are finance concepts, and then you mix them up. And then, for us or the audience needs to understand what they mean, and then how you use that to tailor-made income. But for average investors, where can they start if they would like to have some kind of covered downside or upside? At least it's at least they have this position, but they don't have to do it themselves.
Okay, if you don't want to do it yourself, an easier way is to probably buy a fund, an investment fund, right? That will do it for you. And of course, beware, there could be some funds that don't perform as well, and there will be fees involved. Yes, there will be fees. And for the fees part, you have to make a kind of a calculation for yourself. On one side, if you do options by yourself, depending on the bank you work with, the fees could be more expensive than what you pay for a fund, even though the fund has some percentage there that they take. And the other thing is, so I show you one fund that I like, but without promoting it, right? So we are by no means getting paid for showing investment vehicles here. And this is, again, I thank you for bringing it up before. This
for
is
illustration purpose.
Yeah, this is pure for educational purpose. Yes. So this part is quite interesting because, let me see here. You do have, so this is called Allianz Income and Growth. It's in Singapore dollars. We also have it in US dollars. It could be in different currencies. Oh, now it dropped out. Sorry for that. Very sorry. I go back. Why did that drop out? Oh, because of... Okay, so this fund, I also open here the calculator on the side. This fund pays out 6 cents every month, you see. So the next payment will be on the 21st of July. Every month you get 6 cents. The price of this, you don't see it here, is about 9.83. So it's 9.83. Here's the price. So you have 6 cents every month. So you multiply with 12, you get 72 cents a year, and you divide it by 9.83, you get 7.3% payout. Right.
Would the payout 6 cents fixed every single month per share, or it also fluctuates?
It fluctuates, but it will be changing probably every year, depending on the overall direction of the fund. And if the fund is going much better, then there will be maybe more or less, right? In one way, what I really like about it, this is like the average performance over the last 5 years. Annually, you get 11.2% on this. And this now, for instance, this is exactly the fund I talked about before. This fund has 1/3 high yield, 1/3 convertible bonds, and just 1/3 is equity. So it has a different risk return kind of dynamic. If the stock market drops, yes, it will also drop, but percentage-wise speaking, it doesn't drop that much. On the other side, it generates income, and it is a very interesting diversifier, so to say. And you kind of delegate the writing of covered call options to someone else.
Right.
There could be another one, which is here, the PIMCO Income, which I like a lot as well. This is now the US dollar version. This fund is also quite interesting. You see, it's a fixed income solution that still performs around 5% over the last 5 years, where actually we had very, very low interest rates. How do they do it? They are more in like mortgage-backed securities and so on, and they hedge certain things. They hedge duration, they hedge certain exposure. And the beauty here is you basically also get paid every month. So if I go to dividends here, so the dividend part will come shortly. You also get a dividend that is roughly, it's now just short of 4%. So you have the 0.0367 times 12, which is 0.4404 over the price, roughly 11.3, I guess. So you get 3.8% paid out. And of course, if the total return is 5%, that means the difference is capital gains. You don't get paid out everything, so the value of the fund is slowly increasing. Another thing could be, so companies, again here, no investment advice. This is a company called Iron Mountain. They have a dividend actually that yields more than 5%. It used to be 8-9% when the stock price was a little lower, like here. You could buy this super cheap, and they pay out the dividend every quarter and still try to adjust it higher. You see the dividend is growing. It's a very good example. Companies that usually can increase their dividends over time, they're in a position to pay you more and more. And in this case, this is a company I think is very interesting. Another one is, for instance, Gladstone Land. This is super topish now. So they are the inflation play. Real estate, they write here, but this is actually land. They have farming land, and they kind of sublet the land to farmers who want to grow the soy crops, the corn, all the things there. And also here you see they pay a dividend every month. So you get paid monthly. And also here you see the dividend is increasing every month, every few months. You see here 3 months, then the dividend goes higher. 3 months, it's just a little bit, but they constantly increase the dividend in a way, which is quite amazing because the share price also increases. The yield is now not so attractive. As close as like 18 months ago, you could get 4% something on that, which is quite cool. And of course here, this is where I can construct products on anything. So I want to just show one example here. This one here basically is a barrier reverse convertible. It sounds super complicated. I don't want to bore anyone, but basically you have the value here, the barrier. You say, if the stock price drops below 60%, I will have a problem because I will have to buy the stock. Now let's just do an example. Cannot. Okay, maybe that one is too micron. Maybe we choose some shares that are more risky. I don't know, anyone in the audience has some shares. Here I can choose the currency I want to hedge it in. So let's do US dollars. That's interesting. Maybe we add another share. Which one could be more volatile at the moment? Peloton, maybe. They also don't offer here, so would have to. Let's just do with Micron. Maybe I put this higher. I put this to 80%, this to 90%, 1 year with quarterly redemptions. And I see, do I get some interest on that? Oh yes, we might get 7.52% interest. So now this is a case you can say, okay, I wouldn't mind to buy Micron if it dropped 10%. at 10% discount if it dropped 20%. You don't buy it now, and if you wait for that for 1 year, you may get 7% compensation. Of course, this is something you may or may not like. Now you can say, okay, why not add Berkshire Hathaway? So it will become a Verstov product. So I have two now, and the product gets more risky because you add a second stock. Berkshire, for instance, I would be very happy right now. Instead of 7 point something, you get 8%. Now you could add another stock and increase your yield.
What is this 8%?
This is the coupon. You will get paid by this coupon. And how do they make this coupon? They will sell some options here. So they will sell the options. One option is the barrier options, which defines whether or not you get triggered. And the strike is the conversion option that will define at what price you will get triggered. You can even make it more complicated now. You could do, okay, here I cannot. You could have like auto call levels, monthly auto call.
Okay, for this coupon yield that someone it's like buying an option.
This is like selling a put option.
Selling a put option, but selling the put option on the shares that you already have.
On the shares that you choose to be at risk here, you don't have them. So that would be a cash solution.
So you choose to sell these shares at a certain price, but the shares that you don't have yet.
It's you choose to sell put options on the shares you may want to buy eventually, and you get compensating with a yield waiting for this to happen or not.
But because you need to set your money aside, or why you get the yield on that?
Because you put your money at risk. And this is like a covered put option in a way. So a covered call option, you have the shares. This is a covered put option. You give your money and you get compensating with the risk, right? If you do that in your portfolio without the structured product, you can maybe get a little bit more interest, but you cannot define different levels. And then the thing will be like, you kind of have to have the cash aside.
Right, I see. Okay, I think
that's maybe a little bit too.
This one too, even for me, I mean, like when I had a finance degree, we first learn what is put, what is call, long and short, and then you learn the derivatives and options. And now you are just giving the audience from zero to advanced. But what I find interesting is initially you share the slides talking about how, if people don't have leverage or mortgage, they are not in the same position as central bank when they start to print money. That is I would say that is like a good news for those who have real estate property, but with mortgage when the inflation goes higher. And then we talk about fixed income, very interesting. Also personally, I understand that this fund, they are not pure, simple fixed income fund, but they also exercise some put call options, like the fund managers, they do that on behalf of the investors. So that makes it much more easy.
Yeah. So in essence, what I wanted to show is even though the situation looks like interest rates are low and there's maybe not much you think you can do, there are still many things you can consider. So back to this, right? Interest rates being low doesn't necessarily mean there's no way to generate income. It may just be in a different form, or you have to think a little bit around the corners, out of the box, however you want to call it. And as long as you have assets, that's also what I like to say, right? As long as you have wealth, there is always a way to make it work for you or to get paid from that. That's the essence I want to convey here. And of course, how much financial engineering you want to put into this, or how much consideration you want to give to some more exotic tools, it's up to you. Usually, that's maybe a good way to close this session. If you keep it simple or keep it in a way that you understand what you do. I mean, that's the basic thing. Never do stuff you do not understand. I would highly advise against that. If you think something is getting too complicated, just fingers off, or try to understand it, try to learn about it, and try to see the benefits. And if you take some time to understand some of these other options, it could be interesting. But if you think this is too complex and too complicated, maybe it's not for you.
I'll see there's no more comments from the audience side. And again, if you're watching this replay and you have further questions, feel free to leave in the comments. We will reply you. And if you want to learn more about how to manage your money, how to invest it, money mindset, money habits, please follow this channel. It could be Financial Imagineer Facebook group or Fast Track YouTube channel. Give it a like, thumbs up, and follow it.
And share.
And what?
Share the
Yeah,
content.
right. And share, yes, to help more people understand personal finance. And this is what we try to do. And
Yeah.
if you are eager to learn everything systematically from understand how money works, to money mindset, to money habits, to investing, and to design a system that is working for you, feel free to check out our Fast Track Money course. And the link is in the description below. So we have run 3 batches, and a lot of students, they have given us a lot of very good feedbacks. And we'll be launching an online course pretty soon. And so subscribe the newsletter and you will be notified. Thank you so much for being here with us today.
Thank you. And sorry for the overwhelming information. And thanks so much.
Bye-bye.